Hi, guys. Welcome to the Super Chat on this Sunday. Thank you for being here. Is everyone able to hear me? How's the audio? How's the video? Is it freezing at all? We haven't had an issue with that lately. Thank goodness. Guys, let me know in the chat feed. How's the audio? I think on this StreamYard thing, the audio is a bit, or the chat stream is a bit delayed. So we've got Jordan is saying, woo. All right. Let's see. A bit blurry. Okay. That's probably the internet connection. Hopefully that'll perfect. Great. Audio is good, but video is crap. Shoot. That might be on your end. How's the video for everyone else? All good. Jam Bobby is saying all good, sir. Okay, cool. Catherine, hello from Toronto. Hello, Catherine. Michael from England. Thank you for being here. Let's see. Oh, Gurav, hello from India. Wow, very cool. Thank you for joining us. Eric, good, but not great. Okay. See, low bit rate 5.5. All right, well, as long as it's not freezing and the audio is good, we're going to go ahead and get things rolling. So first of all, the Rebel Capitalist Pro that I talked about last week, that's the product that we're rolling out. Should be this week, maybe the beginning of next week. I've teamed up with Chris McIntosh from Capitalist Exploits and Lynn Alden. She is really someone that's extremely popular with my audience, along with Chris, and you can understand why. These are two of the best in the business. So we're using their research, and then we're adding on a forum, an investment forum, macro forum with live streams, 4 per month. Well, yes, I think it's going to be 4 per month, where I'm going to get on there with Lynn and Chris, and we're going to we're going to walk through their research. We're going to discuss it, and then we're going to do Q&A with the members of Rebel Capitalist Pro. So I want to give you the heads up there. We will be rolling it out very soon. If you're interested in finding out more, if you've got specific questions, you can email Gene, and I apologize all of you. I gave you the wrong email address last week. So I think last week I said it was Gene@georgegammon.com. Well, that's the person that the email goes to. His name is Gene. He is the gentleman that is in charge of the digital marketing side of what we're doing. He's fantastic. But the email address is george@georgegammon.com. So if you've got questions for Gene about anything regarding Rebel Capitalist Pro, or you want to be notified as soon as it's rolled out, make sure you email Gene, and his email address, or the one that he's responding to, is george@georgegammon.com. So just so we're clear there. And one thing I want to go over briefly before we get into the super chats or any questions, I had a lot of confusion this week on Twitter, and I really don't, I'm not sure why people struggle with this so much, but it is a point of confusion, and I want to address it because it's crucially important you guys understand how this works. And I always talk about the market. As you guys know, I'm not a big bull on the market right now. I'm very bearish, but I'm bearish because I think it's expensive. That's the main reason. So I don't want to have anything to do with being long the broad S&P right now. Or that said, I don't want anything to do with being long anything that I don't think is cheap, or buying something that I think is cheap. Now, a lot of people are confusing the broad market with individual opportunities, such as oil. So if I go in and say, listen, I'm considering buying equities or stocks in oil companies, But at the same time, I'll come out with a video saying the market's overpriced and I think it's going down, or I don't think it's a good time to buy. I think we may have a second wave of the cerveza sickness where it'll retest the lows. People, but at the same time, I'm saying, maybe oil or maybe Shell or maybe Carnival Cruise Lines or something like that, maybe that's looking interesting right now. And this is what I was saying back in March. If you guys, I'm sure you guys remember that. So people really have a hard time with, George, why on earth would you buy anything? Why would you buy an oil company right now if you think the market is most likely going to go down? They cannot reconcile having those two views at the same time. And I used one tweet, I used an example of how a lot of the equities that I purchased back in March, like uranium equities, like the coal equities, gold miners, these things are up like 40, 50, some I had one that was up 70, almost 70%. And it wasn't to say, hey, look at, how much of a genius I am or anything, not even close. It was just to show people that you can be bearish on the entire market. You can believe that it's way overvalued, that the central banks and all of this money printing and deficit spending from the government, this is all going to end very badly. But you can have that view while at the same time looking at certain opportunities and saying, you know what, this is actually cheap right now. And I'm going to explore that further in future videos, but I really wanted to communicate that to all of you on the live stream because it's so crucial to understand the difference. And meaning that it's so crucial to what I think is investing well and having a more successful financial future if you're able to compartmentalize those views, right? And that's why I always go back to saying your starting point is never, is the price of something going to go up or down? It's always, is it cheap? I mean, even go back to Shell. When I bought Shell, and what else I buy? Exxon or something like that. But when I bought a couple of the oil companies back in March, honestly, I thought that the probability, and I would give it maybe 60% at the time, I thought that they were going to go lower. Now, and they might have, I can't remember exactly when I bought them. But the point is, even though I thought the probability was that they would go lower, I still bought them. Why? Because they were cheap. You see? So my first priority was not, is the price going up or down? It's, is it cheap or is it expensive? Right? And then a lot of people on Twitter said, well, George, isn't everything that you bought, isn't it, if it's gone up 70%, isn't it expensive now? And well, you just have to look at a chart. Go look at a chart of oil. And where are we now? 35, something like that. If you look at an inflation just adjusted chart for oil going back to 1950, let's say, you'll see that it starts to get what you could call expensive, maybe around 80. So between when, if I'm buying it at 25, let's say, I'm doing nothing, zero, until it gets to 80. And let's say it goes down to 10. All I'm doing is buying more. That's it. And hopefully they're able to maintain their dividend. But even if they don't for the next year or two, that's fine. And if I keep it 10 years, 15 years, that's fantastic. That's the goal. That's exactly what I'm trying to do. But if oil were to get above 80, say 90, 100, well, now all of a sudden I'm in a different mindset. I'm like, okay, maybe it's time to start taking a little bit off the table because I buy when it's cheap, but now it's expensive. Maybe I start to sell. And so but for whatever reason, people really struggle with that. Buying, even though you think something might still be going down, and selling, even though you think something might continue to go up. So anyway, let's get on to the super chats. That's why we are here, to answer your questions. We've got 400. This thing, I don't know if this thing's a little lag on it, but right now it looks like we've got 463 people on the live stream. Thank you very much. So Sebastian, let's throw up the first question, my friend. Doug, thank you for the super chat. Retired, 61. Good financial condition. Awesome. Congratulations. You're in Texas, lake home paid for. You're in an even better position. If you listen to my interview with Robert Barnes, boy, Texas is looking better and better every single day with what's going on in the States. That's for sure. Okay, it's worth $750. We'll probably never relocate. Okay, discuss pros, cons to refi home with 3% 30-year mortgage, invest proceeds. Let's see, discuss pro. Oh, refi, got it. Well, I mean, Doug, assuming that you can take the proceeds and invest prudently to where you're getting a higher return than the 3% you're paying, then it would make a lot of sense, especially if you're able to diversify into asset classes that might not be totally tied to real estate. So in other words, if the equity that you have in your house goes down, maybe another investment that you have goes up. Maybe gold as an example, or maybe the gold mine or something. Or maybe it's Bitcoin. Maybe that's your area of expertise. So I like it for diversification, that's for sure. And then if your house goes up in value, well, great. You still own the house. So you're still realizing the potential upside. I also like it because you're not having to sell your house. Let's see. My guess is you probably paid less than $750 for your house. So if you did sell it to diversify or go into something else, if you're concerned about the real estate market going down, you'd have a substantial capital gain. Now, that said, I understand that, and I don't know if you're married, I don't know your tax situation, but I think the first $250 or $500, depending on whether you're married, would be a tax-free capital gain, assuming that's your primary residence. But even if it's $250, you got 20%. And by the way, let's just assume that Trump for a moment does not get reelected. And I'm not saying I like Trump. I'm not saying I don't like him. As you guys know, I dislike all politicians equally. So that's not what this channel is really about. But let's just assume for a moment that he doesn't get reelected. I mean, is there any doubt that capital gains tax will go up? I just think it's obviously there's no certainties, but as far as if we're looking at the probabilities, I think they're incredibly high that you're going to see capital gains tax go to income, the same level of income as income tax. So then let's say you're making good, excuse me, you're making good money, Doug, and let's just say that your effective rate is, we'll just call it 35%. And now all of a sudden on that 250, you're paying 35%. Well, now we're talking decent money. We're talking 60 grand, something, right around there. So again, I think that's why the refi strategy has upside. The downside would be if you take that money and just blow it on vacations, or you use it to consume and you don't use it to invest, or if you use it to invest in a way where you're taking on far too much risk. Let's say, as you probably know, Doug, I always suggest having 10% of your portfolio allocated to insurance, physical gold, 10% allocated to speculation, and then 80% allocated to something that pays you to own it. So let's say that you're doing this cash out refi at a 70% LTV, loan to value. So I'm not going to do the math in my head, exact math, but just ballpark it. Let's say you're getting 500 grand. So you take that 500 grand and let's say you put the entire 500 into Bitcoin. Probably not a prudent move. Now, I'm not saying that Bitcoin isn't a fantastic speculation. I am saying that to put 100% of your portfolio into any speculation, I don't care what it is, not a good idea. So if you take 80% of the 500, let's call that 400, and you put it into something that pays you to own it. So let's say let's say you're very patient, you wait for the market to come back down to where you can get some good solid RV ratios on rental properties in linear markets, or maybe you even get you take out that equity and prices come down in Texas, where you're able to go into, I know San Antonio had some good RV ratios the last time I checked. This was a few years ago. But you're able to do something like that. So with that 400, you should have plenty of positive cash flow coming in to cover your interest payment on the, let's call it 500 that you take out. So you see what we're doing there? We're taking the 500, we're putting 50 in gold, we're putting 50 into speculation, and then 400 into stuff that's going to pay you to own it. If you do that, then I think you're making a good decision. And in essence, you're being paid to short the dollar, because if you're paying that mortgage back with cheaper dollars, and what I'm implying is that the rate of inflation would be above the 3% rate that you're paying over the next 30 years, then that's going to be a transfer of wealth from the bank to you. Again, because you're paying it back with cheaper dollars. So if you're able to make a positive return or a positive carry on the debt, then, like I said, you're being paid to short the dollar. So as far as the pros and cons are, what's great about the pros and cons is they're really up to you. If you make stupid decisions, or what I would consider stupid decisions, then you got a lot of downside. If you just blow it on consumption, as an example. But if you make smart decisions, then I think you've got a lot of upside. I think on net balance, your upside is a lot greater than your downside. All right, next question. Jojo Shikari, thank you for the super chat. I have 20% physical gold in my portfolio and want to add mining stocks. Okay. Do you hold any miners? What interests you right now if you were looking? Thanks. So with the mining stocks, I consider those speculations, unless you're finding some that might pay you. I think Barrick might have a dividend. I'm not sure, but don't quote me on that. Most of them I see as speculations. When I bought the miners, this was back in March, when what I was referring to earlier. I didn't have time to research the individual miners. I just have not had time. I've been slammed with. I know you'd say, George, you've been in lockdown. How could you be so busy? But honestly, guys, the YouTube channel takes a lot of my time. I mean, often I'm working on it like 10, 12 hours a day with what I'm doing for the whiteboard videos and the interviews and whatnot, and then doing other people's interviews and other people's podcasts. It takes a lot of time. So I just bought an ETF. I bought the junior ETF. I forgot what that is. It was that GDXJ. I can't remember the ticker, but I should look it up right now. You guys know the one I'm talking about, the junior miner. Now, I don't suggest that. For me, that I didn't have time, and that's just a lazy way to do it. So that's one of the reasons why I'm really looking forward to Rebel Capitalist Pro, because I'm going to have the opportunity to dive into Lynn's research and Chris's research extensively and use them as my research employees. And to reiterate my views on research letters, and this is much more than a research letter. Of course, we're kind of building an online community. But with research letter, you don't buy these things just to get stock picks or to get hot picks. That's Kramer mentality. That's booyah, buy. That's not what we're all about. At least that's not what I'm all about. And I think that's a really bad way to look at a research letter or a newsletter. I think the good way to look at it is it's just like hiring an employee to do market research for you. And then that employee reports to you, and then you make your own decisions. I think that's crucial. You're using your critical thought components to come to the decision that's best for you, your financial future, and your own portfolio, because everybody's different. You don't just go there, oh, this guy said that stock's great, I'm just going to buy it because I want to go watch Monday Night Football and drink beer with my buddies and I don't want to put any thought into it. That's laziness. And in my opinion, those people, they'll most likely lose money in the long term. So my point is I'm really excited to dive into these research papers and to discuss them with Chris and Lynn and with you guys, with the members, and really start. And then what I'm going to do, my plan is to sell out of my ETF and then buy individual stocks once I'm able to dive in and do the homework and think about it critically myself. And with the Rebel Capitalist Pro, it's going to force me to take the time to actually do that. So I want to make sure I answered your question thoroughly. So, but let me go back to this. You said you got 20% in physical gold. I might cut that down. I might cut that down to 10%. It's all, and again, I don't want to give people really specific advice, because all I tell you guys to do is the exact same thing I would do for myself, or the exact same things I tell my own mother to do, literally, my own family members, like my sister. I have this conversation with them all the time, and this is exactly what I tell them to do. The same thing I'm doing for myself. It's the exact same thing I tell you guys to do. So, but that doesn't mean that it's perfect. It doesn't mean that it's right for everybody. But if it were me, Jojo, I would probably sell 10% of your physical gold and then use that most likely to go into gold miners and use that for the speculative side. So your 10% insurance, 10% speculation, and then try to figure out where you want to allocate the additional 80% in something that's going to pay you to own it. Okay, next question. Tap-e-op B. Hopefully I'm pronouncing that right. Thank you for the super chat. Okay, what will happen to economies like Ecuador that use USD? A, now that the dollar is strong. B, later when the USD debases or loses value, would they adopt Bitcoin? I don't think a government would willingly adopt. Well, I take that back. If you saw my interview with Simon Dixon on Saturday, he made some very strong arguments for why a central bank would actually want Bitcoin, just like they would want gold. Excuse me, guys. His argument is that they might want it for the appreciation to pay down their sovereign debt. Very interesting kind of thought experiment. And so I'm not going to go that far, but I think there would be a greater possibility of the people in Ecuador adopting Bitcoin, just like they have in, or what I've read. I haven't been there physically. I can't know from boots on the ground, but from what I've read, they've done in places like Venezuela or China, where they're trying to get money out of the country or maintain their purchasing power. So as far as when the dollar is strong, I mean, there's winners and losers. So if the dollar is strong, their imports are going to get cheaper. The problem with countries like Ecuador is they're so backwards from an economic standpoint. What they'll do is they'll put all these huge tariffs on imports, and so they don't really get the benefit of the strong dollar, because their goods that they're importing aren't getting any cheaper. They're just getting it. So it's like a double fail where not only are your exports more expensive, but your imports are more expensive as well. They have all these protectionist policies that I just really don't agree with. Other people who are losers in that standpoint are, well, I'm not going to say all of them, but to a certain degree, the real estate market is a little less vibrant, let's say, because when the dollar was weak, back, call it 2012, 13, 14, something like that, the real estate market in Ecuador was booming because the Canadians and the Aussies and Europeans were flooding in because their purchasing power was increased substantially because of the lower dollar. Moving on to your next question, what would happen? So that's what you're going to see. You would see real estate having a tailwind, in my opinion, if the dollar is debased. And let's see what else. See, another thing that's hard is because the government gets so involved with these tariffs and import taxes and what should happen. Who knows whether it will, because the government will muck it all up. So assuming the government didn't go in there and muck it up, though, their exports would get textbook, what would happen is their exports would get cheaper. So that would be a bit of a tailwind to their exports. Imports would get more expensive. So it would be a headwind to the imports and the consumer, because they've got to import a lot of their stuff because internally the businesses are very weak. It's not because there's not enough protectionism. It's because there's way too much regulation on businesses, and there's crony capitalism that creates these monopolies where it's just not, there's not a vibrance to the economy. There's not a lot of competition, and there's not a lot of growth. If you could just get rid of those regulation or the excessive regulations and maintain a rule of law, and I'm not saying it's chaos there, but the government just changes laws. Like, they just wake up one morning and everything's different. They change the Constitution. That's daily stuff's changing. So that's not a very friendly place for capital. If they were to create an environment that was friendly to capital, that had a lot less excessive regulation, then you go ahead and drop the tariffs, you let everyone compete, and it's going to be a win-win for exporters, importers, consumers. It's going to be beneficial for everyone. But I don't see Ecuador going that direction anytime soon. So that's why it's very hard for me to give you a specific, this is what would most likely happen if the dollar goes up or down. I can just tell you from a textbook standpoint that it would be beneficial to exporters, and it would give a tailwind to exporters and a headwind for imports because it would be more expensive. Okay, I think that's it. All right, Sebastian, let's hit the next question, buddy. Elliot, thank you for the super chat. Interested in Medellin property in areas that would make good Airbnb future, okay? Is that something that you help people find, paid, or point me in the right direction? Feet on the ground deals. Yeah, that's really what you have to be a local expert. That's an interesting thing when you don't have an MLS, when the real estate market is extremely inefficient. I mean, it's inefficient in the United States to a certain degree, but it's 100 times more inefficient when you get outside of especially in these developed or developing or emerging markets, if you will. So you've got two sides of the coin. If you're a local expert, you use it to your advantage and you make a lot more money. Your returns are substantially higher than they would be in a market like the United States, Canada, or Australia that is more efficient. The flip side of the coin is if you don't know what you're doing, you're going to get screwed. You could get lucky, but you're most likely going to get your butt handed to you. So it is very important that if you want to do something like this, Elliot, you spend some time here and work with the right people. That said, I don't really help people do that. I just don't have time. I know that back when we first started the YouTube channel, we had some people come down and I had Sebastian help them out, because Sebastian and other people that work for me are always looking for deals, even when they're walking around, if they're taking the bus, whatever, they know where I like to buy. So if they see a for sale sign in a window, they're always calling and they're just like bird dogging for me. So we had a list of probably 10 properties that we kind of had our eye on, and we're just waiting for the prices to come down. We had maybe reached out to the seller, but they weren't as flexible with their prices as we would have liked. So it's just this waiting game and going back and forth, and it's putting in 10 offers. It's looking at 100 properties to put in 10 offers to just get one deal. But you make the money on the buy side. So when you do that, you do it well, then you can make 40, 50, 60% returns, if not more, just in these, in 6 months, a year, just in a flip. So going back to your Airbnb question, there are areas where that would be good, and there are areas where that would be not so good. So where I am in Provenza, around Parquieras, around the Golden Mile, but especially around Parquieras, that's a great idea. That said, especially now, you could be getting some fantastic deals because there were so many people doing Airbnb, Elliot. And now with the cerveza sickness, I mean, they've just been wiped out. Oh, okay. First of all, I'm sorry, Elliot. Let me pause for a moment. Sebastian is saying no more super chats, guys. I know we've had a lot today. I sincerely appreciate them, but I do have a ton of stuff to do today. So I want to make sure that I'm able to answer everyone's question on the live stream without having to do an extra video on this. So no more super chats, guys. Please, no more. If you put one up, I'm just not going to be able to get to it. And I hate to not answer a question that someone takes the time and energy to actually pay for. And obviously I want to answer all those. So just no more super chats. But Elliot, going back to your question, a lot of the Airbnb people around here have just gotten hammered lately. So if you come down here, especially with dollars right now, because the exchange rate is so favorable, not now, but maybe when you can, when things kind of open back up, you could find some really good deals around here, smoking deals that you just could not have found otherwise. And if someone's got a hard money loan, like I know a few of these guys around here, they do have hard money loans on their Airbnb properties. They could be in a pinch right now. You could come in and provide that liquidity they need, but for that liquidity, you're able to get something on the cheap. And of course, I'm very bullish on tourism in Colombia, more specifically Medellin, over the next 10 years. I'm very, very bullish, as is Jim Rogers, by the way. But both Jim and I are very bullish on tourism, especially in Medellin over the next 10 years. And that, if you can get an Airbnb property on the cheap, that would be, I think, extremely beneficial for you long term. One other thing I want to say about this is Airbnbs are a tricky asset class. Let's just, or a tricky strategy from the standpoint, very few buildings here in Medellin allow Airbnbs. But what will happen is the sellers will always tell you, oh, yeah, no problem. Airbnbs, no problem here. Don't worry about it. Don't worry about it, gringo. No problem. And as a gringo, you'll come down and be like, oh, the seller, they seemed like a nice guy. Sure. Yeah, and you don't understand that very few buildings legally actually allow, like the HOA is what I'm talking about, that actually allow, and it's not like a government thing. It's just the building HOA. But they don't allow Airbnbs. So you come in here and buy a property that someone pawns off on you as Airbnb friendly, not knowing that you as soon as you put it up on Airbnb and get a tenant to come in, the security guard won't let them in. And I see it happen constantly. And so, but that's another reason why you've got to have the boots on the ground intel, and either you use. I would love to help you out, but we just don't have time to do that right now. So I would strongly suggest coming here for a month and just doing all the homework yourself And but making sure too that there are a lot of real estate companies that cater to gringos, and although I think they've got a lot of integrity, but I think you're going to be paying a little bit, or you could be paying a little bit too much there. Not always, but sometimes. So it's just something where you've got to come down and do the homework yourself. And then if you do the homework, and then if you purchase a place, then if you want to, then I'm happy to give you all the resources that I work with, so, such as my designer, my architect, and then you could have access to kind of my infrastructure. But as far as helping you out initially, neither I or Sebastian really have time right now. So hopefully that makes sense. Okay. Next question, please. Email account. Okay. That's an interesting username. Thank you for the super chat. What ETF or stock did you buy as uranium? Same thing. It was lazy. I hate to even mention it because I don't want you guys to do the same thing I did. I didn't do it properly, and I'm looking forward to selling the ETF, although I've made a killing on it. I look forward to selling it to transition into individual companies, which I know are the right way to go about it. But it was just the uranium ETF. It was in fact, I got my phone right here. Let me tell you guys. URA. It was that it got down at like, I don't know, it was like below 8. And I bought it sometime around there. And then the junior, GDXJ was the junior miners, the junior miner ETF that I bought back in March as well. And then I bought coal. Most of you know that. I bought the coal ETF back in March. That's KOL. And but again, with all those ETFs, I want to roll out of them and get into individual companies as soon as I can. Okay, next question. Chase, thanks for the super chat. What would you do if you, let's see, I'm trying to read too quickly. My brain's going faster than my mouth. That happens all the time. What would you do if you were 50% net worth, dry powder, and if you had 50% cash position? I don't know that I'd do anything, Chase. And again, to be clear, guys, when I'm talking about 10%, 80%, 10%, I'm just talking about your investable or what you have invested. That doesn't mean that you don't have any cash. I'm completely excluding cash. So if you feel comfortable with 50% in cash, then by all means. I'm just talking about the other 50% that you want to invest now. That's what you should have, 10, 80, 10. But I think everyone has a different comfort level with the cash position they have. I think you definitely want dry powder right now, for sure. But I think you always want dry powder. It's just to what degree. And that's predicated upon if there's anything cheap right now. And currently, there's not as many cheap things as there was back in March, but there could be a few opportunities out there for sure. So, but I like dry powder because if we get a second wave or if something unexpected happens, I mean, right now the market's priced to perfection, or if maybe the Fed put doesn't work out. If you guys have been listening to Jeff Snyder like I do, make sure you listen to Emil Kalinowski and Jeff Snyder, their show on YouTube. It's Making Sense / Eurodollar University. Jeff outlines how he believes, and he's got a lot of data to back this up, that the Fed's put is really more psychological than it is a function of creating extra bank reserves. and they really don't have much more control over than just the psychology of the market. Well, confidence can come and go. I mean, we've seen that just in the United States. Who would have thought 3 weeks ago that there'd be a lot of places in the United States that would look like a complete war zone, that would look like Afghanistan? Probably, I mean, things can change quickly, and definitely confidence can change quickly. So if the market loses confidence in the Fed, then the downside is substantial, to say the least. So I think dry powder is great. And again, I think it's based on every individual. Some people might be too much, 50%. Other people, and it's all based on your personal expenses as well. Let's say you're someone like a retiree that had a nice bit of money saved up and you just wanted to live on your investments. Well, then you would want a lot less cash, because you would want to make sure the cash flow from those investments were covering your monthly expenses. Where if you were someone that maybe wasn't in that position, then you might want a little bit heavier cash position. So again, I think if that's what you're comfortable with, I think that's great. It's just, I would want to focus on what you're doing with the other 50%, which is the 10-80-10. And buying cheap, selling expensive. All right, next question. Philip, thank you for the super chat. Simon Dixon talked about crypto financial services that eliminate counterparty risk. Yeah. Can you explain? Plus macro impact. Also, please interview Chamath. I can never pronounce his last name. I apologize, Chamath. Yeah, I would love to interview him. I don't think I've actually emailed him, but if I get some time, I will. We've got a lot of people lined up. This week's going to be fantastic, by the way, with the interviews. Just to give you guys a little teaser, tomorrow I'm interviewing Jesse Felder with the Felder Report. He's another one of those individuals that's always on Macro Voices, Real Vision. I'm sure most of you follow him on Twitter. He's going to be I'm so stoked for this interview. It's going to be awesome. And I'm not sure when we'll post it, but I'm going to actually be interviewing him tomorrow. But I'd love to interview Chamath. I just need to reach out and hopefully present the channel in a way that will entice him to say yes. As far as Philip, for me to explain extensively what Simon was referring to and the impact of his ideas regarding using crypto or Bitcoin to eliminate counterparty risk with derivatives, I don't think I can do that on a super chat, buddy. I really apologize, because that is some heavy stuff. I would have to have a whiteboard to do that. And there's a lot of variables in there. As far as a macro impact, well, I mean, if you can eliminate any counterparty risk that you can eliminate, is going to be a more stable system. That I can say. So if you could pull off eliminating a percentage, I don't think you could eliminate all, but a percentage of counterparty risk, then by definition, you're making the system as a whole more stable and more predictable. I think another thing that would do that, and I don't want to put words in Simon's mouth, but I think he would agree with me, is if you could just eliminate this insane lust for inflation that the central banks have. It's just, and it's taken over the mainstream as well, to where now everyone's just freaked out about the inflation boogeyman that's hiding under your bed. Oh my gosh, or excuse me, the deflation boogeyman. Oh, we can't have deflation. Oh geez, if consumer prices actually went down, what a catastrophe that would be. I mean, can you imagine going to Walmart tomorrow and actually paying lower prices? I mean, obviously the world would come just to a complete halt and we'd have Armageddon, right? If you just went out and were able to buy a car next year for a cheaper price, or your groceries were cheaper, or your rent was cheaper. I mean, just a bizarre concept, just straight from the get-go. But my point is, if you set up an economy to where it had and supported healthy deflation, which is in a free market capitalist structure, is what you would have. You would have prices continually going down because entrepreneurs and risk takers, producers would go out there and compete with one another to produce better and better goods and services at lower and lower prices. And the demand doesn't go down, the demand increases, because it's just simple economics. Is demand going to increase for a good if the price is higher or lower? The problem is we have a debt-based economy. And when you have a debt-based economy, then deflation can be a problem. If it can be. It's not always, but it can be. So if we were able to eliminate and set up a structurally sound economy that had continued deflation, I don't think counterparty risk would be as big of a deal, because people wouldn't be forced into taking into assets. Right now, American society, if you want to get ahead and if you want to retire with any decent standard of living, you have to do what? You've got to buy a home. You've got to invest. You've got to put money into a 401k. Well, that's just taking excessive risk. If you go back to the late 1800s, as an example, in the United States, where we had 3% deflation per year, but interest rates that you could get at a bank in a checking account, 4%, or even in a U.S. Treasury, right? Think that through. So you're getting a 7% real return on cash, right? Just having it in the checking account. You wouldn't have a need for people to go into this 401k. You wouldn't have a need for people to have to go into the stock market, to have to buy bonds, to have to buy this, to have to get as much money as they can in their home equity and lever up just to have this chance of retiring with a decent standard of living. You wouldn't need that. The only thing that would be required is that you do what? Save your money. You see? So we go from the system of inflation incentivizes people to take excessive risk and to do things with their money that long term, especially when you have the Fed creating all these asset bubbles, will just, sure, they'll be rich on paper for a time, but then they just get wiped out. And then they go back up a little, and then it just get wiped out. So it all depends on your timing as to whether or when you retire. Where if we had a system that, like I said, late 1800s with deflation, then all you have to do is just save your money. You save your money, and the value of your currency increases. So in 30 years, you're done. You've got a great standard of living just by saving cash or currency. See, that's a huge fundamental change in society, the way we think about investing, the way we think about increasing our standard of living. And what's your asset bubble if you're in cash? If you're getting a 7% return on cash, There's no risk of an asset bubble. There's no risk of a 2008. There's no risk of a cerveza sickness crash. There's no risk that the real estate market goes down by 50%. Your purchasing power isn't affected at all. In fact, if you do have asset deflation, your purchasing power actually increases because you've got the cash in your checking account that has been compounding annually at a 7% real rate of interest. I think that type of system eliminates a substantial amount of counterparty risk as well. So, all right, let me make sure. I know I've went off on a tangent there. I apologize. Let me make sure I answered your question thoroughly. Yeah, I think I did. Okay, next question. Breath of Water. Thank you for the super chat. Hey, George, what do you think about Dave & Buster's as a speculation? It seems like everyone has stopped caring about the virus in the US and are going stir crazy. Yeah, but see, Breath of Water, you're looking at it the wrong way. In my opinion, you're looking at it the wrong way, or you're starting with the wrong question, because and maybe I'm not understanding your question. If I am, I totally apologize. But to me, what you're doing is you're saying, okay, I see the price of Dave & Buster's, the stock. I didn't even know they were a publicly traded company, but I see the price of Dave & Buster's going up in the future because everyone has stopped caring about the virus in the US and are going stir crazy. So therefore, I think a lot more people are going to be going to Dave & Buster's in the future, just like a lot more people are at home watching Netflix or buying their groceries on Amazon, or so therefore, I think because you're going to have this change in the behavioral patterns or the spending patterns of people in the United States, Dave & Buster's is going to benefit from that, and therefore the price of Dave & Buster's stock is going to go up. Don't think that way. That's what I'm saying. Don't think that way. Now, you can get to that point. I think that's totally cool. But I'm just saying that shouldn't be your starting point. Your starting point, in my opinion, should be looking at a chart of Dave & Buster's. Maybe you go to Yahoo Finance. And what's their PE right now? And what's their PE compared to where it has been since they've gone public? And I have no clue how long they've been public, but let's say they've been public for 20 years. Okay, well, what did their PE get down to in 2008 and 9? What did it get down to in 2001? What did it get up to in 2000? What did it get up to in 2007? What did it get up to more recently in 2019? And I'm talking about their PE ratio. And so then you can see, all right, is it at a 100 PE right now? Well, if it's at 100 PE right now, assuming that back in 2007, it was at a 10 PE, and I know I'm using extremes, but I'm doing that just to prove a point, then I don't care how many people are going to be going to Dave & Buster's in the future. I'm not buying the stock because it's not cheap. And sure, the price could go up. I could be wildly bullish on Dave & Buster's. You could ask me, George, do you think the price of Dave & Buster's will go up? And I could say, yes, absolutely I do. I think the probabilities are the price of Dave & Buster's goes up. And let me do an entire whiteboard video on why I think the price of Dave & Buster's will go up. And then you could ask me another question, George, would you buy Dave & Buster's? And the answer could be unequivocally no. Well, why not? You think the price is going up. You see what I'm saying? Because it's not cheap. And now I'm just assuming that Dave and Buster's right now could be fantastically cheap, and and therefore, kind of take what I said just as kind of a tutorial or just conceptually rather than specific advice. But you get my point, and I'm just assuming you're kind of coming from the point of just getting your priorities out of order for how to analyze whether or not you should even consider it, right? If the question would have been, hey George, what do you think about Dave and Buster's? It's trading at a 5 multiple, and it's usually at 20, and it seems super cheap right now. If you look at a chart, it's bottomed out, or compared to what it has, it's even cheaper than it was in 2008 and 2009. If the question would have been phrased that way, then I would have assumed that you might have been prioritizing, and I'm not going to say prioritizing correctly, just in a way that I would suggest. So again, hopefully that makes sense, and hopefully I was able to answer your question. Well, actually, let me answer it specifically. If Dave and Buster's is cheap compared to what it has been historically, and based on the way you analyze things, then yes, I'd consider it. But I would not consider it just because I think the behavioral patterns in the United States might change, and they are going to be a potential beneficiary. I think that's the best way that I can summarize my opinion. Okay, next question. Identity Block, thank you for the super chat. Hi, GG. Would you consider teaming up with other Act 22ers in a type of ombudsman role? I'm guiding PR government. Welcome home. Well, I'm not in PR yet. I lived there. I set up my residency there back in maybe 2014 or so. Currently, I am not in PR. I'm trying to get there. I'm doing my best. I'm in Medellin. I don't know if I said it on last week's live stream, but I actually went so far as to try to charter a plane to get there. I tried to charter a 50-foot catamaran to get there, and it ain't happening. So it just goes to show you that no matter how much money you have, if you're at the wrong place at the wrong time, doesn't really matter. So I'm not quite sure your specific question and type of ombudsman role. Maybe he's a politician or she is a politician, but I don't know. I've been so disconnected from PR for quite some time. But yeah, I mean, I would love to meet and hook up and chat with other Act 22ers when I get back to PR. Always a great group of individuals, often kind of that liberty mindset that you guys know I'm all about, and they lean kind of libertarian free market. So yeah, and they're obviously going to be people who are into producing and taking action and kicking ass, and that's what I'm all about. That's who I like to surround myself by. I think there's no truer statement than what's the saying? You are the sum of the 5 people you spend most of your time with, something like that. I think that's very powerful, and I completely agree with that. So I'm always trying to look for people that I can spend time with that are much smarter than I am, that are much more successful, and really learn from them. And that's one of the reasons why I started the channel. And it's the main reason I started Rebel Capitalist, the interviews, because I wanted to talk to people that I know are a hell of a lot smarter and more successful maybe, and just have researched things to even a greater degree than I have. Okay, next super chat. Jay Kerr, thank you for the super chat. Best place to invest, protect sums of cash greater than 1.5, short-term in cash to T-bills, have an upper limit of insured. Okay, good idea. Credit union NCAs. separate money market account. Oh, don't do a money market account, man. If that's your question, Jay, I'm assuming you're by you're referring to a money market account. I would not do a money market account, especially not a money market fund. And I know they're different, but with a money market fund, they're going straight into the repo market often. And I would not want my savings, the money I have to have that I cannot afford to lose at all, the money that I see as being allocated in a way that's as close to risk-free as possible. I would not want that money in the repo market. Think about that. You got your life savings, or the money that you think is being allocated at a very low risk, and that's going to HSBC or Deutsche Bank, something like that. And I know it's less likely in the US repo market, but you never know how the money flows. And I just wouldn't want anything to do with the repo market right now. And yes, I do. I think over 1.5, I'd have it in T-bills, just short term, super short term, less than 3 months if you can do it. And just to be clear, I know I always get pushback on this. George, why on earth, if you're so bullish on the debt and if you think we're going to have stagflation, and why on earth would you suggest treasuries? Those people always conflate the 10-year and the 30-year with the 3-month. And I'm not saying, again, you got to compartmentalize your thinking here. I am by no means saying by a 2-year even, or a 10-year or a 30-year. I'm only saying just for very short-term dry powder, just a 3-month or less even T-bill, and then just keep rolling it over really quick. And then when you do need the dry powder, boom, you got it. You got massive liquidity. And going back to the repo market, that there's always going to be a ton of demand for at least short-term for those T-bills that you're buying, because going back to Jeff Snyder, that is the pristine collateral that the dollar funding markets need. Therefore, if there's going to be a bid, you're a lot less likely to have it go against you, but you're not going to sell it anyway until it expires or until it comes to maturity. So it's really not a concern, but that's definitely what I do. I would not want 1.5 in a bank account. That's for sure. Now, T-bills, I'm not sure. They don't have really they're not insured. They're just backed by the government. So I'm not, if you had them, maybe, I think you might be confusing, Jay, the T-bills with the FDIC insurance on cash in a bank account. Yeah. So if you just buy T-bills right from the government, they don't really have any insurance. The government, I guess, could not pay you, but I think that's incredibly, incredibly unlikely over the next month or two. I don't know anything about the credit union insurance, so I wouldn't want to comment on that. I'm a fan of having multiple bank accounts in small banks and also in larger banks. I personally have a bank account, a couple of them, with Wells Fargo. But I've got other accounts with a small bank in Kansas City, where I've got a few of my rental properties, and where I know the VP of commercial lending, I think is his title. I know him extremely well. And I know him well enough to when I am back in Kansas City, we go to dinner, we meet for coffee, we meet for lunch. So I know him that well. So I think it's good to have a mix there, but I wouldn't want anything over 250 because I wouldn't want to exceed that FDIC limit. That said, of course, FDIC cannot even come close to covering everything that they're insured. Remember, they've got maybe 140 billion in assets the last time that I checked, the FDIC, and they're insuring over 10 trillion in deposits. So how good is that insurance at the end of the day? And then, of course, the next argument is, well, the government will bail them out. Probably, but I wouldn't want to bet on it. So, Okay, next question. Super Traveler. I like the username already. Thank you for the super chat. Where do you purchase your physical gold and silver? Right now, I'm not, because I've been in lockdown. So as you guys know, when I get an extra 50, 100 grand, whatever it is, I take if I get 50 grand, I take 5 grand and I buy gold with it. If I get 100 grand, then I make sure that as soon as I can, I take 10 grand, I buy gold with it. It's almost like a tithe in a church, the church of gold. But right now I can't, because I'm in lockdown. And although I shouldn't say lockdown, Colombia's opening back up. It's very similar to the United States right now, which is great. But I still can't leave the country, still can't come in. It's very difficult to get shipments or anything. So what I'm doing currently, Super Traveler, is I'm buying Rick Rule or Sprott's ETF. That it's PHYS, I believe. And I did homework on it. And number one, I trust Rick a lot. Number two is I like the fact that it's obviously you want something that's backed by physical gold, but they store it in the Canadian Mint, and your custodian is the Canadian Mint, if I read it correctly, compared to the GLD, where your custodian is HSBC. And for me personally, I just trust the Canadian Mint and Rick Rule a lot more than I trust HSBC. So it's not ideal, but as soon as I can, then I'm going to sell the physical gold, or I'm sorry, the PHYS, the ETF, and then buy physical. And when I do, I will definitely tell you guys for sure who I'm buying my physical gold from. Okay, next question. Micro Business Media, thank you for the super chat. FYI, I think Sebastian is limited on characters for the question at the bottom. Oh, okay, maybe that's it. I'll have to talk to him about that after the super chat. Hence all the abbreviations for longer questions like the stock market. Okay, I appreciate that. I didn't realize that. So Sebastian, let me know if that is true when we get done today. Okay, next question. Rang 2300, thank you for the super chat. If gold is protecting our purchasing power and 1 ounce of gold buys the same amount of goods and services, how can people claim gold is an undervalued asset? Well, a lot of times it goes up in excess of inflation, or a lot of times it doesn't. Well, and also too, it's all relative to the money supply. It's not all relative, but to a certain degree, it's future expectations of inflation. It's not what has currently happened. So if you're just basing it on what has currently happened up to this point in time, but you've got to look and say, okay, what is inflation going to be in the future, and where is the price of gold now adjusted for inflation relative to where it's been? But then you also look at M2 money supply. You look at the Fed's balance sheet, but I think M2 money supply is kind of a better gauge, because as you guys know from watching my videos, the Fed's balance sheet doesn't always mean more M2 or less M2. It can, but it doesn't always. There's correlation, but it might not be causation, because bank reserves, it's really technically not money printing. That's the base money. It's better to look at broad money, because that's what's circulating, or the purchasing power that's circulating within the real economy that can actually buy the gold. So yeah, I mean, it's a very interesting question, but I think it's more looking in the rearview mirror than looking through the windshield at what is coming ahead. And so I think that's where people claim that gold is undervalued, because they could see it potentially against where it's been in the past, especially where it's been in the past adjusted for inflation compared to the M2 money supply. Okay, next question. Abby, thank you for the super chat. Can you research the index bubble effect due to passive investing of Americans' 401ks? Yeah, I actually did a video on this, which was extremely popular. I think it's got almost, I know it's got over 150,000 views, maybe even 200. But it was Michael Burry. Remember about 4 months ago when he came out and said that he was bearish? He thought actually ETFs were kind of like a same type of problems that mortgage-backed securities had, and those the tranches, the CLOs, I believe they're the CLOs, but he saw them as having very similar problems. And I outlined what those problems were on a video. Basically, the underlying asset isn't as liquid as the shares of the ETF. And you can have, and then you have a middleman there that's buying the shares and buying the, I don't want to go into all the mechanics of how ETFs work. It's more complicated than, or it's more complicated than I'd like to explain on a live stream. But with a whiteboard video, I think you'll really get an idea of what the potential problems may be. So just on the thumbnail, I'm not sure the date, but if you look at the thumbnail, it's got Michael Burry on, and it's a red background, and it says something ETFs on the thumbnail. And it was maybe 3 or 4 months ago. So I'd point you there first and foremost. Can you research the index bubble? Affected due to passive income. Yeah, I think I would point you there, Abby. And if you've got 10 or 15 minutes, that would be a great use of your time. And I explain it much better on the video with a whiteboard than I can right here on a live stream. Okay, next question. Free Thinker, thanks for being on the super chat again, my friend. Always enjoy seeing you here. Real estate may go down in real terms, but my dry powder is losing value in real terms. So how do you balance this? So this is a great question. There's really no way to do it perfectly, Free Thinker. If there is, it's not coming to mind. Because to your point, you've got to be in some hard assets. It's just all about trying to find an asset that's cheap, and then allocate some of your resources to that, and then assuming that it continues to go up in price, or it goes down less than real estate does in real terms, then you sell out of the asset that's hopefully expensive and parlay that into real estate that would be cheap. Another way, I'd have to do the math on this, Free Thinker, but if you had rental properties, linear markets, if you're able to, and I'm not saying going out and buy now, but if you are able to get them a little cheaper, you let the market come to you, let's say over the next year, you're not going to most likely lose a massive amount of purchasing power. So in nominal terms, they're coming down. If you're able to buy that cash flow with cheap fixed rate debt, so getting a 30-year mortgage, and again, I'd have to do the math on this, but just thinking out loud, if you had that asset that was giving you positive cash flow, you had equity in it, and it was going down in real terms, the value of the debt you have would also be going down. So there would be a counterbalance to your purchasing power going down. Now, hear me out. I understand you wouldn't be in cash, but you would have the equity. So if you're continuing to expand your equity, or your renters really are growing your equity for you, then if we have real prices go down, then due to inflation, and you've got the fixed rate, then when we got to a point in time where you thought you'd want to buy, where as maybe even a speculation because home prices are so low, then you could take out your equity in the form of more debt, a cash out refi. And I don't know if you'd be losing purchasing power. It all depends on the amount of purchasing power you're gaining by the debt decreasing in value because of inflation. And obviously I'm talking about some stuff that's very difficult to think through without a piece of paper and a pencil and a calculator. But that's where I'd start. I'd start by asking, how can I be in control of debt, productive debt, that's paying me to own it? Where if we have inflation, my purchasing power is increasing because it's a transfer of wealth from the bank to me, from the lender to the borrower, and then use that to have access to purchasing power to take advantage of real estate in the future that could be cheap. And now you may be asking yourself, well, George, that doesn't make any sense, because if I have the debt on the house and the house is going to go down in real term, right? But you've at least got a counterbalance on the real value of the house going down, while at the same time the real value of the debt is going down. Where if you just had cash, you might not have that counterbalance. Again, I'm just spitballing this, guys. So I might not be thinking this through entirely, but that's where I'd start. And then I'd try to get into assets that where I could parlay that might not be as susceptible to inflation. And what I would do, now that I'm thinking this through, you've got your gold there. So, and then most likely on the speculative side, especially now, you would be in commodities, Bitcoin, maybe gold miners, which if we had that inflation would do well. So you've also got a counterbalance there. And if you're taking the investment side of your portfolio, and if you're diversifying your currency risk, that could be a way to do it as well. So you've got, let's say, real estate in XYZ country that's not on the dollar. So if this plays out, like you're saying, and real estate in the United States goes down in real terms, you've got dry powder in the form of equity, or maybe just cash. Maybe you've got currency. Maybe you trust the Singapore dollar. Maybe you trust the New Zealand dollar or something like that. Maybe you've got some there. But see, you've got diversity with your exposure to not only governments or not only currencies, but governments as well. Your political risk. So I think that's pretty much where I'd start. I'd look for counterbalances, and then I'd look for with potentially using debt, and then I'd look for counterbalances in my own portfolio with the insurance side and the speculation side, meaning that they would most likely appreciate with inflation that would bring the prices of the homes down. And then I would also look to diversify my political risk and my currency risk. And I think that's the best answer I can give you right off the top of my head. All right. Next question, please. Matt, thank you for the super chat. Thank you for all you do. You had mentioned Cleveland as being a bad, did I say a bad linear market? Okay. I don't remember saying that, but okay. As being a bad linear market for real estate investing during a Jason Hartman recap a few months ago. Why don't you like Cleveland? I haven't really looked into Cleveland, but right off the top of my head, I think Cleveland would be pretty good. Maybe I just a lot of times what I think and say, it's guys, I make mistakes, and I'm by no means perfect, and I'm not the most articulate person in the world. That's for sure. I bumble over my words all the time, as you guys know from watching the live streams. Sometimes my thoughts aren't as coherent as I would like them to be when I actually communicate them. I could have just made a mistake and said something the opposite of what I was trying to say. But I think Cleveland would be very interesting. I'd like to look into Cleveland, Matt. So I think that's the best way to answer. I can answer your question. Unless the population was decreasing, that would be really the only reason I wouldn't like to look at Cleveland, is if the population was decreasing, like a Detroit. But as far as I know, it's kind of consistent. So I'd look into it for sure. All right, next question. Rups, thank you for the super chat. What do you think about purchasing cryptos and lending them as collateral for high returns? Yeah, Simon. Yeah, I know. Simon Dixon mentioned this, but I'm very afraid of placing 100,000. Oh, dude. Yeah. So I haven't been able to dive into this with Simon as to the extent that I would like to, or I most likely will in the future. I've actually got a conference call with, if you want to call it that, with Simon on Wednesday to dive into what he's doing and what I'm doing more extensively to see if we can work together on something in the future. Just FYI. I would say that you're seems to me you would be taking on counterparty risk there, and quite substantial counterparty risk. I'm not saying it's not a fantastic idea. Obviously, Simon's a super smart dude, and he's got a good understanding of risk. I don't know that I would do it with 100 grand unless you've got a portfolio of 100 million. So what I'm saying is, if you think this is a fantastic idea, and it very well may be, I don't know I would do it with the entire 10% of the speculative side of my portfolio, and I would not consider that an investment. I understand it's paying you to own it. I get it. But for me, to take it even a step further, the investment side, I've got to have. I don't want something that can go to zero. And if I'm buying a rental property as an example, it's not going to go to zero. I mean, I guess there's a 1% or a super small chance that it can. Anything's possible, but the likelihood is just extraordinarily low. Where with a crypto, it could go to zero. I'm not saying that they will. Bitcoin, obviously, much less likely than some of these other smaller ones, but I just wouldn't do it with the entire 10% of the speculative side of my portfolio. Maybe just 1%, something like that, or maybe 0.5 if you think it's a great idea. And quite frankly, I think that Simon would agree with me. I don't want to put words in his mouth, but I don't think he'd be saying, hey, do this with 50% of your portfolio. But I look forward to talking to him about it on Wednesday for sure. Okay, next question. Mr. Lev C, thank you for the super chat. I'm confused about deflation and inflation. Yeah, it's actually much more nuanced than it appears to be when you look at it just surface level. So you're not alone, my friend. How do you define deflation and inflation? What are the key markers you use to recognize each? Well, so it's all about nuance. I don't know that you can look at inflation and deflation in broad strokes. You've got to look at it individually. So are you talking about inflation, deflation in the price of food? Are you talking about asset prices? Are you talking about things that are purchased with debt. So as an example, if I think there's going to be a debt deflation, well, that's not exactly the same thing as saying that your food prices at Whole Foods or Trader Joe's or Walmart or whatever are going to go down. Those are two separate things there. So if I'm saying, okay, I think we're going to have deflation in things that most people use debt to buy. So I would say that the market would be, you'd have some deflationary pressures there because a lot of people lever up to go into the market. Housing, you might have some deflationary pressures there because most people use debt to buy a home. Cars or high-end vehicles, or man, now they're also expensive, but like $80,000 Ford pickup trucks, probably deflationary there, meaning prices are going down in dollar terms. So, but then you look at education, you look at possibly rents. I mean, rents could be both, could be on, depending on how you're looking at them or what you're renting out. If you're looking at healthcare, if you're quite frankly, if you're looking at taxes, big one. If you're looking at what most people buy on a daily basis, I think even the people who are pretty hardcore deflationists would say, yeah, you're probably not going to see too much deflation there. And so, and then, but that said, what certain individuals buy could be different. And what percentage of their expenditures are allocated to things that are going up or down in price. If you're someone that's making $1 million a year, a lot more of what you're buying will most likely be, could be going into a state of deflation, where a very small percentage of what you're buying, because you allocate such a small percentage of your income to food, could be going up in price. So it's not only difficult to measure inflation because it's very nuanced from one good or service to the next, but it's also different for every person. As far as the key markers that I would recognize, well, I think with assets, it's pretty easy because, again, it goes back to, is it expensive or cheap? I would look at rents. I would look at, I just look at what people are buying, including their taxes. I would look at energy, housing, food, insurance, education, and travel. I think I'm just, again, I'm spitballing here, so I might have left out some important ones, but right off the top of my head, that's where I'd focus. As far as if real price is what people are actually paying for stuff, if they're going up or down. And honestly, I just do kind of my own little thing where next time I go to the grocery store, I just kind of write down what the price of what I'm paying, maybe do a little spreadsheet. That might be cool. If you're putting it into QuickBooks anyway, maybe you're just noticing what you're paying for insurance, what you're paying for your kids' tuition. I'm sure most people pay a lot of attention to that. And then just kind of maybe write it down, put it onto a spreadsheet, and then just compare it year over year. And then you'll answer the most important question, and that's what is what you are buying in a state of deflation or inflation, and that's what's most important. Okay, next question. Looks like this might be a two-parter. Okay, assuming dollar milkshake theory materializes. So Brent Johnson, good buddy of mine. Aren't we likely to see Applause Accord 2.0 in 2 years? Could this happen even without the U.S. consent? So yes, I think if that were to materialize, if the dollar were to go, call it 120, 130, 140 on the DXY, I think you would see Applause Accord 2.0. I think Brent would most likely agree. In 2 years, I mean, I can't answer that. It's tough to really put times on when something is going to happen. I think you can put probabilities on it happening, but I just hate to say, you're right, in 2 years it's going to happen. Could it happen without the United States? Good question. It could, but I think it's highly, highly unlikely, because then these countries would have to willingly increase the value of their currency by taking it out of circulation. And you're talking about doing this when we're in a currency war. And that's the mindset of governments and central banks. They want their currency devalued, and they've got tons of debt. I mean, what country is going to want to increase the value of their currency if they've got a lot of debt? Maybe if they've got a lot of USD debt. But see, again, there's so many Keynesians running the show right now that they just want a cheaper and cheaper and cheaper currency because it boosts exports and all these things they always talk about. I don't know that they'd be willing to do that. So, I mean, physically, could it happen? Yeah, but I don't see it being realistic, or I think the probabilities are very low. That said, I think the U.S. would be all about it. I think the U.S. would, I don't know why they would say, no, we want this wildly strong dollar. I think they'd want to bring it down as well. So, and then how would they do that? I've tried to think this through so often, because it's not as easy as it seems. Like, they can't just wave a magic wand and boop, the dollar is devalued. Even if the Fed is able to print money, they're printing bank reserves. So how do they get those bank reserves into the system outside of the United States? Remember, the money supply right now, M2, broad money, even outside the United States, whether it's in euros, yen, it's really controlled to a large degree by commercial banks and government spending as well. But commercial banks and retail banks, I mean, Steve Keen and Richard Warner, these guys just nail it here. And they point this out all the time. And Snyder points this out too, that the commercial banking system, they're the ones that are really creating the money supply. It's not the Fed, the money supply in the real economy. Now the government is a bigger player because there's so much deficit spending, and that's creating M2 money supply as well. And the Fed and the central banks are monetizing it. So, but again, going back to that, so you've got, there's a big issue there. Like, how would they do it? And I don't know if they could print, take their balance sheet and print, call it 2 trillion of bank reserves and just get them into the FX market. I mean, they just sell the dollars. I mean, I guess I'm not sure how they do it. That might be above my pay grade. You might have to ask Brent that one. I'd have to really think that through. That might be an interesting whiteboard video. I'd like to think that through. But again, that's not really your question. Your point is, could this happen without the United States? It's possible. It's unlikely. And I think if they did Applause Accord 2.0, the United States would be right there saying, yeah, I think that's a great idea. Okay, next question. Zach, thank you for the super chat. How likely we will retest the lows? Okay, got it. Will it likely be when Q2 or Q3 earnings report, or usually take longer than that? As far as the time, I have no idea. I have no idea, Zach. I think the catalyst has got to be something that the market is not expecting, and just that totally blindsides the market. So as an example, right now the market is assuming there's going to be a full recovery in the United States economy. Assuming there's not going, they assume that even if there is going to be a second wave, that governments are not going to go into lockdown, but they're also assuming that people won't lock themselves down. This is what I think could be a catalyst. It could be something that no one's really paying attention to, and I haven't really heard too many people articulate or really think through. And that's, we had a severe problem in New York, as everyone knows. So for New Yorkers, this is front and center. They probably knew somebody that fell very ill. Unfortunately, they might have known someone that passed away as a result of the cerveza sickness. So it's real to them. If you talk to someone in Texas or Kansas or Colorado, one of these areas that really hasn't seen a big issue with, it's not even real to them. Like they don't even, it's just not even, it's out of sight, out of mind type thing. So what happens if, and I'm saying if, I'm not saying this is going to happen, but what happens if we had a situation where a New York type of experience, and I'm not talking about the experience with the lockdowns. I'm just talking about that many people getting sick. What as far as a percentage, what if that happened in or everywhere else, right? And then the governments could come in and they'd say, oh, we're not locking anything down. We're not doing that again. Feel free to continue to go to restaurants and to bars and to do all these things. But the people themselves, all of a sudden, they have a different attitude toward the cerveza sickness. And again, I'm not saying that's right or wrong. I'm not saying that they should have a fear of it or they shouldn't. That's not what this video is about. But it's if they do, then they lock themselves down. Now, all of a sudden, the economy tanks without the government intervention. It tanks from a bottoms up, not a tops down. I don't think the market is pricing that in at all. I mean, zero. So, and that's an example of something that may happen. I mean, the probability is above zero. It may happen that would blindside the market, but something like that would need to happen in order, in my opinion, in order for us to go back down to the March lows. There's got to be something unexpected. And I think the probability of something unexpected happening, and I'm not saying it's going to be what I just walked through, but especially, I mean, look at what's going on right now with social unrest, rioting, looting, a pandemic. You've got an election that's going to be incredibly contentious. I mean, think about how emotional this election is going to be for groups on both sides. To think that we're going to go the rest of 2020 without some sort of event happening or multiple events, and I hate to even go there, but let's remember when things get tough economically, what do politicians typically do? They blame foreigners. It's always the easiest scapegoat ever. And so if we continue to blame foreigners, whether we're right or wrong, I mean, does a trade war turn into a real war? And I hate to even go there, but my point is, over the next 6 months through 2020, I think, and I don't know what it would be, but I think the probability is high that something happens or multiple things happen that the market just isn't pricing in and just is not even cognizant of right now. And that's when I think you get the potential leg down. Another thing that I'd like to point out, guys, and this is totally anecdotal. I have no evidence for this. So just take it with a grain of salt. But one thing I've noticed since I've started studying macro and investing as much as I have since 2012 is I've noticed markets tend to hurt the most amount of the greatest number of people possible. I've also noticed that markets tend to crush retail investors anytime they get the opportunity to. And usually, especially if people are trading, I mean, 99%, I don't know what the number is, but let's say 90% of retail traders are gonna lose money over the long run. We as human beings are hardwired. The way we're hardwired is perfect to lose money because we let our emotions dictate what we do. We don't like doing the thorough research. We want to buy when everyone else is buying. We want to sell when we're really hardwired to do the opposite of what is correct. So whenever I see retail investors making massive amounts of money and people like Warren Buffett being on the wrong end, I get apprehensive. I think over the long run, the retail, and I hate to say this, but I just think it's true. Over the long run, the retail investor, especially trader, is going to lose money. And I think over the long run, the Warren Buffetts, the pros, the experts at that level are going to make money. And if you go back to 2000 or to the late 90s in the .com bubble, same thing. Warren Buffett was getting his butt handed to him, and the retail people were making a killing on paper. But guess who had the last laugh? So when you look at how much cash Buffett has on the sidelines, and then you juxtapose that to what's going on right now with these people that you hear about all the time with their Robinhood accounts. When you look at Buffett selling his shares of the airlines, and you look at the ETF, I think it's called JET, Jet, being the most popular as far as on the long side ETF in Robinhood accounts, I get worried about that. And again, it's totally anecdotal. It's just I look at it from a human psychology standpoint, and I would rather be on the side of Buffett than the Robinhood people if I'm going to have to predict who is going to come out of this on the right side of history. So I think, I know I've got off on a tangent there, but I think it was relevant, hopefully relevant, to Zach's question. And let's see, I want to make sure I answered it well. How likely is a retest? Okay, I got that. Q2, I got that. Or usually take longer than that. Okay, I think I've answered the question well. All right, next question. Chuck, thank you for the super chat. I have a $57,000 mortgage on 160K. Okay. Of that fixed value home fixed for two years. Okay. How important do you think it is to get a 15-year fixed? That's the longest fixed available in the UK. I'm not sure, because it would have a lot to do with how much you're going to have to pay to roll your debt over, or in like fees. I don't know how much it would cost, Chuck. So if your bank's going to nail you for rolling it over or to refi or whatever, maybe it's not a good idea if you only got $57K on your mortgage and you got 160 value of your home. You got a lot of equity. If you had a 160K mortgage, then it would be different. But with only that 57, I think that's the best way for me to answer your question. Obviously, the fixed rate is optimal, but you'd have to just compare what you think the rate of inflation will be in excess of your interest rate over the next, call it 10, 15 years, compared to, and that meaning your upside, compared to the downside of how much you would have to pay the bank in order to roll the loan over. And I would start with those numbers, and I think that'll give you some clarity. Okay, next question. Bana Bala. Very cool username. Thank you for the super chat. What money advice would you give for someone stuck in Syria? It's going to be, I don't know that I'd change my investment advice at all. I would still do, if possible, I'd do the 10-80-10. I would diversify your political risk. I would diversify your currency risk. I would buy what's cheap and sell what's expensive. Yeah, I don't think I'd really change it too much. Now, I don't know if your situation in Syria, it prevents you maybe from doing that. I don't know. I've never been to Syria. I would like to go in the future, but I have not been there. So unless there's something that's drastically different, and I don't know if you're able to set up brokerage accounts. I would assume you would be. I don't know why you wouldn't be able to. In the United States, maybe there's some restriction that maybe they're, I don't know if they've got the U.S. Maybe they have some restriction on Syrian citizens. But if that were the case, I would just set up an account in Europe somewhere. I'm sure there's plenty of brokerages there that you could use. I personally have a brokerage account in Cyprus, and so I'm sure you could get one there. But I would still use the same methodology. I don't think it would change at all. I would probably want to prioritize diversifying your political risk and your currency risk, though, for sure. And I definitely want gold. That's a no-brainer there. Okay, next question. Atlas, thank you for the super chat. How would you allocate into the Dragon portfolio with your 80-10-10 portfolio? Thanks, G. Well, Atlas, I'm actually in the process of going back and forth with Patrick Serezna from Macro Voices, and we're definitely going to do a series on how the average Joe and Jane can build a Dragon portfolio. So most people, it's easy to go into the equities, the bonds, the gold. For most people, the commodities trend following, it might not be they might not really know what that is, but access to the information, I think it's all, you can buy a book on trend following. I think you can do that on your own. The problem lies in the volatility and how do you go long volatility. So I'm going to be discussing that specifically with Patrick and going over ways that you can do that. So now taking it a step further, I would strongly encourage, Atlas, if you do have a little time, watching the video I did the other day on going on how to go long volatility for the average person. And I don't want to click off my screen. I'm tempted to click on it on the YouTube tab right now and tell you what video it is, but I don't want to mess up the live stream. So if Atlas, if you just go, I can't remember when it was, but it was specifically on like investing advice. Maybe it was last week but if you have a little time, watch that. And I go over things that I would suggest. And one is not only thinking about how you can go long volatility from the standpoint of your portfolio, but also your physical location. So, security, taxes, that's what I'm talking about with your physical location. And I set up the video I'm referring to, or I'm thinking about. I did an example of 3 individuals. I think we had poor Peter, we had middle class Mike, and we had rich Richard. And I went through, okay, poor Peter could potentially use this type of strategy. Middle class Mike might have some more flexibility, and then rich Richard, this is what I would do, or what I would consider. And I would start there. And then I know I've got another video on the Dragon portfolio itself and potentially other ways to look at volatility for your portfolio. And I would start there and then make sure that you're tuning in. So when I come out with the instructional videos with Patrick, that I think that will give you a lot more of the kind of professional trader way to use options to execute that structure within your portfolio. It's just I'm not a trader. I don't know much about options at all, and that's why I want to bring in the experts like Patrick to give you guys that advice, because I know he's the pro. Okay, next question. T-Con, thank you for the super chat. What's up, G? What up? 350K in equity in NorCal. Okay. If I sell, I would wait things out and rent. Okay. I think that's smart. Thus, a 1031 exchange might not work out for me to avoid cap gains. Yeah, it's tough, isn't it? Ideas. What are your preferred linear markets? And F Reno. All right. Well, yeah, you might not be a big fan of Reno, but I think there's some other places that might be within a reasonable drive that may be a little more friendly from a tax standpoint than Northern California. Ideas. What are your preferred? So ideas on the cap gains, it's tough. Unless you could roll it right into buying in a linear market. I don't know if you really want to do that right now. You guys know from watching my live streams that although I love real estate linear markets right now, I'm not a buyer. I'm just in a holding pattern. I think I would prefer to be patient, let the market come to me, but I'm always looking for deals. I don't know. I don't think you can avoid the cap gains. There's no way. Because even if you're a resident of Puerto Rico, you'd still be paying cap gains on that because it's US based real estate. And that's in a different category. You know what, though? One thing I might tell you is if you're considering selling, I would do it right now because the chances are very high. Your cap gains now is going to be less than it is in a year or two. So I know it sucks to pay any cap gains, but if you got to bite the bullet, it's better to pay 20% cap gains compared to 40% cap gains. As far as my preferred linear markets, Kansas City, that's just because I know it so well. And not all of Kansas City, just the Missouri side. The Kansas side is more tenant friendly. So as a landlord, I'd prefer to be on the Missouri side. I usually like Independence and Blue Springs and Lee's Summit, but with all the social unrest right now, I'm not a big fan of Independence. It's more of that neighborhood is more, there's good and bad, and there's areas there that I would not want to be as a landlord. Yeah, but Blue Springs better, but Lee's Summit is the best. So if you're going into a linear market right now, not only pay attention to the RV ratios, but make sure that you're really paying attention to the area. And on a few of my recent videos, I suggested that if you are buying right now, even if it's a rental property, I would suggest buying in neighborhoods where there's a lot of owner occupants. I think the chances of vandalism happening in a neighborhood where the majority of people own their own home is less likely than if it was a lot of renters. And I know it's weird I'm saying that because you're buying a rental property, but that's kind of how I'd look at it. And I would definitely be cognizant of the neighborhood and the area right now if I was considering a purchase. I mean, who wants to buy a rental property and expect this income and then just have a riot come through and destroy it or burn it to the ground or something? It's a lot of that risk right now that you got to consider in the United States, unfortunately. As far as other linear markets, I would hop on Hartman's website because he does so much due diligence, and I would just look at what markets he was in as far as his business, and I would start studying those markets to see if there were any that I was interested in. Personally, that's what I would do. If I wanted to buy something right now outside of Kansas City, I'd start with Hartman's website. So jasonhartman.com. Okay, next question. Mr. Levsey. Okay, same person here, same gentleman. I'm hesitant about gold as insurance against hyperinflation. Good real estate stocks can also protect. Seems gold is hyped up lately. What am I not seeing? Yeah, but make sure that you're buying insurance for insurance. So unfortunately, I think a lot of people see gold as a way to get rich. I'm going to get rich. You could, and I'm the biggest fan of gold out there, but I think that you're better off seeing gold not necessarily as a way to get rich, but as a way to stay rich, or to maintain your purchasing power. So I think you're kind of looking at anything that you do wanting to increase your purchasing power. And if we go into hyperinflation, boy, I mean, you're right. You can real estate stocks could be a hedge, but my goodness, I would hate to go into a hyperinflation mode without having some gold or silver. Oof. I would not want to do that. But that's why you diversify. That's why you don't have 100% of your portfolio in gold. And that's why you don't have 100% of your portfolio in real estate or stocks. That's why you have 10% in gold as insurance. And then you've got 80% or 90% for that matter in potentially real estate or stocks. So if I'm right or I'm wrong, you still come out okay. I think right now in the environment we live in, your main focus should be preservation of capital. I don't think it should be capital appreciation. Now, we're always looking for appreciation, and I do think that you can build wealth in these types of environments. I think there's going to be huge opportunities, but I do think your first priority should be capital preservation. And I just, whenever that's your number one priority, you got to have gold, in my opinion. Okay, next question. Cody, thank you for being on the super chat or on the chat or the live stream. It's always good to see you. I'm having a hard time locating the news, but have you heard of private equity firms selling off assets or taking massive losses? If there is a bailout vehicle they can tap into. Well, I mean, their bailout to a certain extent, the repo market, their bailout for liquidity. That doesn't necessarily mean that they just get what you're referring to as a bailout. I'm trying to, there's so many of those darn 4-letter programs, Cody, and 5-letter programs. I'm trying to think through each one to see, to think if it would be, well, I think the Main Street Protection Program, if that's what it was, that, because it's private equity is going to be, they're just a conglomeration or an aggregate of businesses. So if the businesses they own are being bailed out, then in essence, they are being bailed out. And those businesses they own could definitely get a bailout from the Fed from the standpoint of they're buying high yield bonds, they're buying junk debt through ETFs. They've got this Main Street Protection Program. They've got the PPP, which I think that's part of the CARES Act. So that would be more government, but same type of thing. Whenever you see a bailout for large corporations or businesses, that could potentially be an indirect bailout for the private equity firms that own those entities or have a sizable position in those entities. Ditto that for real estate. If we see, I'm thinking this through, if the Fed comes in, they're buying mortgage-backed securities. They're buying tons of them if you look at their balance sheet. So it would depend if the debt the private equity firms have, if that's been securitized, if the Fed's buying it. I'm just trying to think. I'm just trying to go to all corners, trying to figure out how that might play out. But I think the main way that the private equity firms would be bailed out is through the businesses they have equity in. As far as them selling off assets or massive losses, I have not heard about that. I know BlackRock's getting a windfall because they're the ones that the Fed ordained to do all of their buying. So they're making a killing on the Fed buying these ETFs to the extent they're buying them. But that's just one. So I other than that, I have not heard. Okay, next question. Farrell, thank you for the super chat. What brokers do you recommend to avoid counterparty risk? I know all the pros use interactive brokers, so they know a lot more than I do, and I think that's the best thing I can do is just refer you to the broker that all the professionals use, because they're looking at this counterparty risk just like I am. Okay, next question. And Sebastian, can you do me a favor and text me how many more super chats we have? I know we're at the 2-hour mark. I tried to do an hour and a half, and that wasn't going to cut it. But if you could text me, I'd appreciate it. Micro Business Media, thank you for the super chat. Peter, an engineer wants to mine asteroids. Okay, with trillions of precious metals, including gold. NASA is to land one soon. Not good for gold price. Yeah, that's quite a speculation. I mean, it's a possibility, sure, that we could just be inundated with tons and tons and tons of gold. But what's the likelihood there? And again, if it happens, okay, 90% of your portfolio isn't in gold. So I think you've got to look at probabilities there. And when you look at the probabilities, I don't know if I would be making large decisions, especially over the next 5 years, based on mining gold on an asteroid. Not saying it's not possible. Really cool idea. But I wouldn't, that wouldn't play into my decision-making process. I think that's the best way I can say it. Okay, next question. Zach, thank you again for the super chat. What's your take on dollar shorting? On the dollar shorting going up? Okay. Is it going to get worse or will it start recovering? Oh, going down. I'm sorry. Going down. I'm not reading this correctly. What's your take on dollar shorting going down? Is it going to get worse or will it start recovering? I think you're going to have a bid in there for the dollar for quite some time, especially if we get another wave down in the market where we're kind of what the pros call risk off. And that just means that when they're risk on, everyone's buying equities. They're buying kind of the stuff that is perceived to be more risky. But when it's risk off, people are going into bonds or the dollar, gold, maybe gold, something like that. So if we get another downturn in the market, then I think you're definitely going to get a bid for the dollar. I don't think the dollar is going to go down to sub 90 overnight. I think with what the Fed's doing, there's a lot of risk in the dollar, although I completely agree and appreciate and respect Brent Johnson's view and Jeff Snyder and a lot of other guys that are just 100 times smarter than I am, that are dollar bulls. But I would point out that all those guys are only dollar bulls in the short to midterm. I don't know anyone that I would respect a lot that's a dollar bull over the next, call it 10, 15 years. And not that they're not out there. I just haven't heard that articulated well, that type of argument. So again, I'd look at Zach, I'd say, is it cheap or is it expensive? And right now the dollar's not either. It's kind of blah. It's not, I mean, it's been more expensive in the past and it's been a lot cheaper in the past. So it's just kind of right in the middle zone. And again, this question is more about price. Is the price or is the dollar going up or down? Remember, that's kind of the question we're starting with here. Is the market going up or down? Is the dollar going up or down? Is Dave and Buster's going up or down? Just please try not to start there. Try to start with, is the dollar cheap or expensive? And I think if you look at a chart, you're going to see like of the DXY, you're going to see it's kind of neither based on history. And therefore, I'm not really a buyer. I'm not a seller. Okay, next question. Jonathan, thank you for the super chat. On your show with Robert Barnes, he mentioned he uses some great law firms who have employees who are ex-government for second citizenship. Yeah, I tell you what, that was an awesome interview. That was one of my favorites. I really, really enjoy talking to Robert. Can't wait to do it again very soon. Do you know which law groups he uses and who you can recommend? I don't. He and I talked a little bit after the interview. We didn't get into that specifically. I would, for second citizenships though, I would strongly suggest looking at Simon Black's website and Andrew Henderson. Two guys I really enjoy their content. Simon doesn't do too many podcasts anymore. I wish he did because he's really great. But Andrew is always doing podcasts, and he has a YouTube channel where he's very active. So Simon's website is sovereignman.com. Andrew's website is nomadcapitalist.com. And I think if you start there, they're going to have a ton of free information. They have paid services as well, but 99% of their info is free. And just go on their website and just start diving into. Simon is a lot more kind of written content, where Andrew is more of the YouTube and podcast. So I would start diving into their content, and I think you're going to learn a lot about second citizenships. And they're going to have access to the law firms that you're talking about, and they're going to know all those people. And just, I don't know if I said it in the Robert interview or not, but just so you know, right now, a lot of those second citizenship programs are on sale. You want to talk about cheap? Those are cheap right now, because a lot of the islands in the Caribbean that sell these programs, where a lot of Americans kind of scoff at it, like, St. Kitts and Nevis, whatever, sure, you got a passport for that. Where is that going to get you into Afghanistan? Is that going to get you into Africa? No. These are very, very powerful passports that have visa-free travel to a lot of countries, a lot in Europe. And I think St. Kitts and Nevis has visa-free travel to the United States even. But I know one of them I was looking at the other day, I think Antigua, has visa-free travel to 129 countries. That's a solid passport. And my point is, because tourism has been hit so hard, which is obviously the majority of the income for these islands, they're looking at any way to generate revenue. And one of the ways they're doing this is dropping the price on their passport programs or citizenship programs. So a lot of them I've seen are 50% the price of what it was just 2 months ago, 3 months ago. St. Kitts, I remember, they used to require at least $400,000 in investment in real estate if you went that path. But now I saw this on sovereignman.com. They're now at like 200, 230. So almost 50% cheaper than it was just 2 or 3 months ago. So if you're going to get a second citizenship, now's the time to do it. Yeah, so I think that's where I'd start, Jonathan. Next question. Licardo, thank you for the super chat. Is there any book you would recommend for a beginning economist financer? Yes, for sure. I'm assuming you're wanting to potentially invest in the future, Licardo, and I would start with Beat the Dealer. And I always start with Beat the Dealer because that's the one that most people are surprised by. That is a book on blackjack, and it was Ed Thorpe who did the book. And it's not so much because I'd encourage you going out and playing blackjack, although I think I would, if people really want to train themselves to think properly about probabilities, and I would actually suggest playing blackjack. I think it trains your mind. But Beat the Dealer is more, or any, I wouldn't say anyone. I would stick with Beat the Dealer. It's going to help you understand why you should prioritize probabilities in not only your investment strategy, but your life and business. I can say this with 100% confidence. There is no way that I would have been a self-made millionaire at the age of 34 and been able to retire at the age of 38 if I would not have learned to play blackjack. And it's not that I made any money in blackjack, I made my money in business. And then once I got out of business, I made my money in the investment world in real estate, as most of you guys know. But if I wouldn't have trained my mind by playing blackjack, and if I wouldn't have understood probabilities like I did by reading those books, I would not have been as successful as I was. So I'd start there. As far as economy, you got to read Thomas Sowell's Basic Economics. I would read Jim Rogers' books. I would read the Market Wizards books. And I would read The Intelligent Investor by Ben Graham. That's where I'd start. Okay, next question. Jet Setter 747. Thank you for the super chat. If S&P retests March lows, considering Fed's purchase program of investment grade corporate debt, do you see corporate debt ETFs, e.g. LQD, maintaining value or following S&P into correction territory? It's tough to answer because you're wanting me to try to predict what the Fed is going to do and then how the market will respond to what the Fed is doing. And I don't know. I can only speculate. If you want me just to speculate, yeah, I mean, I think the Fed would come in and buy enough of the ETF to maintain the value. Sure. Does that mean that I would buy LQD? Nope. Nope. No way. Number one, I'm not going to bet on that. Number two, the LQD isn't cheap, right? It might not be expensive, but it ain't cheap. So I'm not a buyer. All I'm doing is sitting back and just giving you an opinion on what I think may happen. That's different than actually proactively buying or selling something. Goes back to what we talked about at the beginning of the live stream. But I do think the Fed would step in because if they lose control of the corporate debt market, it gets really ugly really, really fast. There's a lot of systemic stuff going on there. So I would definitely assume the Fed would step in and be more aggressive if need be. But it goes back to Snyder. If the reason the LQD shot up is because, not necessarily because the Fed came in and started buying, but they just said they were going to, and that had the psychological effect that Powell wanted, that the players in the market actually hit the bid. It wasn't the Fed. Then if it is a psychology game, that psychology or that confidence can go boom, gone. So if you want me to go out on a limb, I would say most likely the Fed will do everything they possibly can to prop up the market and to prop up corporate debt, even assuming the S&P goes into correction territory. But will it keep prices up? Maybe, but maybe not. I think, and I know a lot of people said, well, why don't you buy these ETFs that the Fed's buying? It just goes back to what I say till I'm blue in the face, because it's not cheap. All right, next question. All right, let me see here. Oh, we got 2 + 5 more after no more. Okay, so we're getting close to the end. Okay, cool. All right. 2 hours and 18 minutes. I gotta get going. I gotta get exercise, get some lunch here. Okay, Calvin, thank you for the super chat. Hi, George. Could you comment on how fiat currencies of fiscally prudent countries will fare during global hyperinflation? I think they'd fare a heck of a lot better, Calvin. I'm not a big fan of any fiat currency, as you know, but if I had to own a fiat currency over the next 10 or 15 years, boy, I'd sure rather have Singapore dollars than US dollars. That's for sure. But I think it goes back to making sure that your portfolio has some sort of diversification with your currency risk. And of course, it goes back to gold. Gold's the ultimate. Gold's the ultimate currency, if you will, or money. But to answer your question specifically, yeah, I do think that a fiscally prudent country, if we go into an environment, especially in developed economies, where people lose confidence in fiat currency altogether, those types of country, you're probably going to lose less purchasing power than in other economies like Japan, like the United States, that from a fiscal standpoint has a lot of problems, and those problems are only getting bigger. Okay, next question. And Bitcoin. Let me mention Bitcoin, but I do see that as potentially a currency down the road. It's not now, but it potentially could be. But again, I see it as a speculation. But I want to throw that in there for all the Bitcoin people. Okay. Okay, Garrett, thank you for the super chat. Have any tips on finding countries, states to retreat to if things get out of hand in the U.S.? I would start by watching the interview I did with Robert. I uploaded that on Friday. That goes into, as far as my personal priorities and what I would want for my family, security and taxes. We really dive into that, especially with states within the United States. Like, where do you not want to be? Where do you want to be? As far as countries, it really depends what your priorities are. If your priority is to kind of bug out, and if your priority is freedom and mobility and having as many options as possible, over the next 2 years, I think the Caribbean is your best bet. That's what I'm going to be doing myself. And I'm going to take you guys along with me throughout the process on the YouTube channel. I've actually set up another YouTube channel that we'll be launching soon that is less about econ and finance and more about this type of stuff. And so whether it's through a vlog type format, I'm going to be showing you guys exactly where I am and what I'm doing to increase my personal freedom and to make sure that I've got as much flexibility as possible. If we get another wave of the cerveza sickness, if we get a lot of social unrest, and unfortunately with the social unrest, I think it's only going to get worse in the United States. It's not going to get better. But I want to be somewhere where I can. The thing that's neat about the Caribbean is you've got like 10 sovereign countries within like a 1-day boat ride. Let's say you're based in Puerto Rico. You've got the Dominican Republic. You've got the U.S. Virgin. You've got the British Virgin Islands. You've got what else around there? You've got Cuba. You've got the Cayman Islands. You've got, and I don't know if these are all within a 1-day boat ride, but you've got St. Kitts and Nevis. You've got Dominica. You've got St. Bart's. You've got all these places that may have fewer restrictions than others. So let's just say that you're in Puerto Rico, where I plan to be soon, and all of a sudden Puerto Rico says, oh, we're going into lockdown again. We've got this second wave and it's even worse than it was before. And we're going to put this curfew and blah, blah, blah. And but then let's say you just go on your laptop and you're like, okay, well, what's British Virgin Islands? What are they doing right now? And you see the British Virgin Islands, maybe they're saying, listen, we don't have a problem here. We're not going into lockdown. We want to keep the tourist thing open, and you're really free to do what you want. If you want to stay in your house, stay in your house. We suggest you wear a mask, but if you want to go out on the beach, go out on the beach. Then what I would do, what I'm planning on doing, is going right out to my boat or a plane or helicopter, whatever you choose, whatever means of transportation you've set up for yourself as a plan B, and saying, okay, let's hop on the boat. I'm going to kick up my feet. I'm going to have a couple beers. I'm going to enjoy a gorgeous sunset. I'm going to enjoy this warm weather, this blue water. I might hop on and do a live stream on YouTube so everyone can check out what I'm doing, and maybe they can come along for the ride. Maybe we can have a meetup in the British Virgin Islands, something like that. But you see where I'm going with this, that you just shoot over there, and maybe the BVI, maybe when you get there, you're like, I don't really like BVI. Great, no problem. Let's just shoot over to St. Bart's. Maybe you go down there and stay at Hugh Hendry's place, and maybe you can take some paddleboard lessons from Hugh, right? While you're talking macro. You see what I'm saying? You've got a lot of options. And right now, if you're in the United States, if you're landlocked in Georgia, as an example, and a lot of Americans don't realize this. And I'm hoping it's getting more open now. But as of a month ago, if you were a resident of a certain state, you couldn't go to other states. They wouldn't let you in. And I don't think a lot of Americans realize this because they don't travel. They stay within their little 1 mile radius of their job and where they live. And they didn't try to go to another state. So they didn't know that they couldn't have done that. They were restricted. And you're definitely landlocked. I mean, Mexico cut you guys off, or cut us off as Americans. Canada shut the border down. Sure, you could have gotten a flight, but there were a lot of countries where if you show up with an American passport, they're like, no, ain't gonna happen. Go right back to the United States. We don't want you here. Not that they don't want your tourist dollars, but if they think that the United States has a big problem with the cerveza sickness, they don't want American tourists coming in and bringing that to their country. So these are the things that you really have to consider. And I just, for me personally, over the next 2 years, and after 2 years, it could change. I may want other options, and I always come back to Medellin, of course, because I like spending a lot of time here. 3, 4, 5, 6 months a year. I love spending in Medellin. I'll most likely do that indefinitely, depending on what's going on. If I'm worried about my potential mobility, let's say, I'm going to be in the Caribbean. So my point is, it really depends on what your priorities are. And if your priorities are the same as mine, then I would suggest looking there. Okay, next question. Chris, thank you for the super chat. Can you clarify investments that make money versus speculation? What's your outlook for dividend stocks? Are there ones you like or sectors you like? So first, Chris, I would define investments as things that pay you to own them. Speculation, I would define as things that I just think the price is going up or down, maybe on the short side. But really, I just think the price is going up. That's a speculation. So it's not paying me to own it. So if I buy gold miners or the uranium ETF as an example, or Bitcoin, that's a speculation. It's cheap. It's something I think is cheap for whatever reason. And I think it's something that the price is going to go up over the next 10 years. So I want to buy it. But it doesn't pay me to own it. Rental property would be, in my opinion, an investment. It's paying me to own it. A dividend paying stock would fall into the same category, paying you to own it. Potentially a bond would, and I'm not saying I'm bullish on bonds, but potentially a bond would be an investment. It's paying you to own it. And so as far as my outlook for dividend stocks, see, this is the problem that people got into in Twitter, because I went out there and said that I purchased equities in March. And people just got all hot and bothered. But George, how could you? You're a hypocrite. You're misleading people because you're doing these videos saying that the market's expensive and doing all these things while at the same time you're going behind people's backs and actually buying the market. How dare you? Okay, first and foremost, obviously, for those of you who watch my videos, you know that's nonsense. But secondly, the mistake they made is they assume that when I talk about buying an equity, they think I'm talking about every equity. They think I'm talking about like the entire S&P 500 or something like that. No, not at all. Let's use March as an example. Back then, I thought that coal stocks were cheap and they paid a huge dividend. And I thought there were some oil stocks that were cheap. They were. I think most of them have cut their dividend now, but they cut their dividend. Excuse me, some of these oil stocks were cheap. What else? I thought some of the uranium stocks were cheap. The gold miners I thought were cheap. That doesn't mean that I think you should go out and go long the S&P 500. You've got to compartmentalize things. So my outlook for dividend, I have no outlook for dividend paying stocks because I don't know what dividend paying stocks you're referring to. As far as what's my outlook for the dividend stocks I purchased, well, I think that some of them can still be considered cheap. I don't think any of them could be considered expensive. And then as far as the sectors I like, it would all be based around either precious metals or commodities. That's really actually, let me take that back because banks could be interesting because a lot of them are being just beaten, and I haven't looked at them in the last 2 weeks, so they could be up massively for all I know. But a lot of them really were cheap, relatively speaking. And most specifically Wells Fargo, and I purchased Wells Fargo, but I didn't do it in March, so I did it. I can't remember when, but when I was talking about the majority of what I did buy was in March. Wells Fargo was not a part of that. I can't remember when I bought it. I bought it when it got dirt cheap, like a month ago or something like that. But when it was a very large portion of my portfolio. But what's interesting about some of the banks is if you look at the excess reserves they have with the Fed, they've got a lot of excess reserves. Now this isn't to say that there's a lot of banks that are struggling that I wouldn't want to touch with a 10-foot pole. But some of them could be interesting at the right price. Just American banks. When you look outside the American banks, they're not as capitalized as well at all. But it is interesting. The Fed is creating all of these bank reserves, and those bank reserves are going onto the balance sheet of a lot of these banks. And now I understand that they're going to get crushed. Their loan books are going to get crushed in the near future. But if you're buying it for 10 years, could be something to look at. So sectors I like would be, and I don't know if I'd say I like banking. I would put it on my watch list, and and commodities, of course, and precious metals. That's personally, those are the items that are on my watch list right now. Let me make sure I'm answering this thoroughly. Investment, make money, diversify. Yeah, we got that. What's your outlook? Dividend paying stock. Okay, we got that. All right. Okay, yeah, I think we got it. All right, next question. Last question. What? I don't know what Sebastian just put up there. He just put up our affiliate link with Katusa. Okay, here we go. Colin, thank you for the super chat. Are you bearish after fake jobs numbers they unveiled Friday? Yeah, it was crazy, wasn't it? Reported to have been 100% fabricated. Will market care? Friday's move was parabolic. Again, I wouldn't make any investment decisions based on whether I'm bearish on the entire market or bullish on the entire market. I'm definitely bearish on the market from a standpoint of I think it's wildly expensive. It doesn't mean that it can't go and double doesn't mean that the S&P won't go to 5,000. It's just I'm not a buyer, and I think the probabilities are looking back after in the next 2 years. I think, especially when you adjust for inflation, which I don't think that most people are doing properly. Like, I don't know if you guys saw the video I did the other day, but I'd strongly suggest watching this one where I went back and adjusted for a 5% inflation rate since 2000 instead of what the government would tell us, maybe call it 2.5 with the CPI. And for those of you like me that would suggest that that are under the assumption inflation was a lot higher since 2000, since the year 2000, so over the last 20 years. If you adjust for a 5% inflation rate, the S&P 500 is actually lower today than it was in 2000. Lower. So let me repeat. If you purchased stocks, or the S&P, let's say, in the year 2000, you would have less purchasing power today. How can I say that? Because if you adjust for a 5% rate of inflation, although the S&P tripled or close to tripled, adjusted for inflation, you actually lost money or you lost purchasing power. So you gotta, I think my point is in 2 years, especially when you adjust for inflation, I think the market's going to be lower. But that doesn't mean that I'm out shorting stocks. So again, it's about just really paying attention to the market, but taking action just based on value. As far as will the market care, I don't think so. I don't think so. I don't think the market's going to care about anything. I think it's only going to care about good news, meaning the market goes up. And it's not going to care about bad news at all, unless the bad news is completely unexpected. Then it'll care. So if we just get a bad jobs number, the market's not going to care. It's going to go up because it's expecting bad jobs. They're just using that as an example, right? If we see the GDP, Atlanta Fed come out and say that GDP is going to be down by 50% or what, some insane number, the market's just going to, whatever, shrug it off. No biggie. They're just going to keep going. Fed's got our back. What do we worry about? We know that. We knew that was going to happen. But then if they get an upside, like GDP only goes down by 49% as opposed to 50%, then the market's going to shoot up probably. Doesn't mean you want to buy it, but the market probably shoots straight up. But if we get another round of the cerveza sickness and people lock themselves in willingly so, then it's a whole different ballgame. Or if we go into a war with China, if we have more social unrest that is prolonged, these are things that the market is not factoring in, and that's what would make the market go down. Okay, is that are we done, Sebastian? We got another one? I think, Aaron, you just did a super chat, buddy. And you gotta, Aaron, I sincerely appreciate it. I'm going to answer your question for sure. But in the future, please try to look at this ticker thing we have going down there. Okay, here we go. The ticker thing that just says no more super chats. But I sincerely appreciate it, my friend. And let me go ahead and do my best to answer your question. What do you think of the Eurodollar theory of Raoul Paul and Bill Tai? I didn't watch that whole interview. I've watched bits and pieces of it, and I heard Raoul talk about it on their market recap show. I forgot what it's called. I watch it every day. But the market recap they do on Real Vision, on the one he did on Friday with Ash Bennington. I get a little hesitant when I don't know, and I don't want to even go there, but I would be more curious in Art Berman's view of that conversation than my view. Art Berman has an understanding of how oil interacts with our economy. He has a better understanding of that than anyone. And I know they were talking about how electricity is stored value in the same way gold is, or I'm sorry, the same way oil is. I don't know. I don't know if Art would agree. And so I would love to hear Art's rebuttal to Bill Tai, if that's how you pronounce his name. But that said, I think everyone should, if they have the opportunity, should watch the interview, which I definitely plan on doing when I get a little time here, because you got two super, super smart guys that really know their stuff and are talking about some very high level concepts that I think could be fascinating. And I think it's something we all need to really pay attention to. And even if we agree with it or don't agree with it, whatever, I still think it's something that we would benefit from, just really trying to understand where they're coming from. And but I don't know if it's as much of a, I don't want to call it a panacea because I didn't watch the full interview, but I don't know if it's as probable as it may seem, just because of the energy density of electricity versus oil. And that is not to say that electricity is superior or inferior to oil or vice versa. It's not what I'm saying. It's just from an energy density standpoint, it's not the same. So, all right. Is any more super chats, Sebastian? I think we're done, buddy. Last question. All right. I think that's it, guys. Thank you very much for sticking with us for 2 hours and 40 minutes. Holy cow. Man, I'm actually surprised I can talk for that long. But I appreciate you all being here. Remember to look for Rebel Capitalist Pro, my partnership with Chris McIntosh and Lynn Alden, the online member forum, the live streams. You guys are going to love this product, let's call it, or service. Why are you going to love it? Because it's the service that I created for myself. It's what I want, and it's the way I like to learn. I like to get this fantastic research from people that are absolutely brilliant, like Lynn and Chris. I like to browse through it. I like to highlight things. I like to look at the charts. But then ideally, I would like to listen to that person that wrote the research, that did the research, actually talk about it and walk me through their mindset and why they see things the way they do. And then I would like to ask them questions, my personal questions about the research they did. And then I would like to go into an online community and talk about it with other members of the community. That's Rebel Capitalist Pro. So if you guys have any questions, more specific questions, or if you want us to give you the heads up via email when we actually launch, make sure you email Glenn, and the email address he is using is george@georgegammon.com. And other than that, guys, I'm going to go over to the chat and just thank a bunch of people personally. We've got Jim Wolf, thank you for being here. Annette, thank you for being here. Brandon, thank you. Mark, thank you very much. Miro, thank you. Who else is here with me to the end of the super chat? Hi, Jane. I think this chat stream's a little delayed. Emil, John or Puan, thank you for staying all the way to the end here. Now they're coming in. Ricardo, thank you. BC Joey, thank you very much. Calvin, thank you. Gerald, thank you. Steve B, David, Vicky. Now they're coming in. Guys, I sincerely appreciate it, and I will see you on the next video.